Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and I'm excited to have XYPN's Senior Compliance Consultant, Scott Gill, as well as Michael Kitces on the show today to discuss the current state-level regulatory environment for RIAs or financial planners doing financial planning. We wanted to dive into this issue as it's become a bit of a hot-button topic with the state regulators on how financial advisors are charging for services they are providing to clients and what should be considered reasonable and fair for the consumer. We started off with the discussion on the issues we're seeing, such as tying financial planning fees back to a percentage of AUM, forcing advisors to justify their fee using an hourly rate, or not charging for access to a financial advisor. This led to a discussion on the different ways regulators view financial planning and investment management services and why that has caused a conflict with our members and how we're navigating that. We closed out with a discussion on what XYPN is doing to address these regulatory issues and what advisors can do to help us move the ball forward. I hope this episode gives you some additional education on the issues, as well as hope that this is in fact a solvable problem. XYPN Live is a financial planning conference unlike any other in the industry. At XYPN Live, you'll learn real strategies for building your firm, whether you're just getting started or you're a seasoned firm owner. Or maybe you just want to earn some CE credits, connect with other advisors, or be part of the real financial planning movement. XYPN Live offers all of that and so much more. Go to xyplanningnetwork.com/XYPN Live Radio to get your pass today. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/213. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here's my interview with Scott and Michael. Hey, Scott and Michael, welcome to the show, guys. Thanks so much for being on.
It's good to be back. It's been a while. We have, as someone's probably going to tell us in the comments, like we're a little overdue for a mailbag episode as well. It's been a while since we got to hop on here, and now we have an extra guest. I don't want to say extra. I feel like that makes Scott like an unfortunate
additional
guest. An additional guest. For what I think is is this the first time, Alan, that XYPN Radio has ever had a 3-person interview? No,
we've had a few with dual firm owners and things like that. Yeah, Scott has been on. It has been a while since Scott's been on. It may have been a couple years since we did a compliance focused episode. So Scott, welcome to the show.
Thanks a lot. I appreciate you.
So do we need to introduce who Scott is for people who, if they haven't been listening back 100 episodes, they'll be like, who's this Scott dude?
Yeah, we'll do listeners heard a intro to Scott in the intro, but I think we can also say that, Scott being our senior compliance consultant, previously our director of compliance, and then moved into this role in order to actually spend a lot more time on today's topic, which is compliance and regulatory environment and advocacy and what we're doing to really navigate it for our members. So this is really a big part of Scott's job now, is a lot of the conversations that are going to come up today. So, really just to set the stage for listeners, the regulatory environment has been shifting for us here at XY Planning Network. When we first started and we were just registering a few firms, the regulators just sort of approved all of our ADVs and it was never an issue, and we didn't really have a lot of conversations. And then as our, the number of registrations started ramping up, I think we did 180 new RIA registrations in 2018. We're on pace to do more than that this year. I think we've done over 450 RIA registrations now. We actually represent a very meaningful percentage of all of the new state level RIA registrations that the regulators are seeing. And so now, in addition to us just sort of filling the desks of the regulators for new RIA registrations, along with the fact that some of the bigger players, whether it be some of the broker dealers like Cetera and HTK recently talking about subscriptions, that suddenly the subscription model is really hitting the mainstream from a vernacular standpoint. Schwab starting to do financial planning for $30 a month. I think it has become the most front and center topic that the regulators are starting to face. And so what we want to do is just sort of talk about the environment that we're in today. So if you listen to this episode in a year, the environment will have changed. So just recognize that if you're not listening to this in July of 2019. But just, what is the regulatory landscape? What are the issues that we're dealing with? And then we'll close out talking about some of the work that we're doing here at XY Planning Network to try and have a positive influence over some of those discussions. So let's just sort of kick it off. Michael, I'll let you take the lead with just what initially do you see is sort of the concerns that regulators have? Like why, we know subscription-based financial planning, it's the most transparent model, it's the most consumer-friendly model. So of course regulators should just approve it and not talk to us about it. Like why are we having issues with this? Sort of what's your take on that?
So ultimately, to me, at the core, look, the job of regulators is to protect consumers, and it's to protect consumers about, frankly, not just the known harms, like, hey, person is doing bad thing, we need to stop this person from doing bad thing, but it's also from unknown harms. When you look at most of the harm that happens to consumers, it happens when people go outside the standard regulatory boxes and processes. Right, even down like where does most fraud happen in the RIA channel? It happens when people self-custody assets and they're off the usual third-party custodian overseeing all the assets. When you move outside the normal regulatory realm of the standard stuff, it tends to put the regulators on defense, or I guess I should say like on offense right out of the gate, because the minute you're doing something that is not standard, the risk that not standard leads to something that's harmful for consumers that regulators didn't even know was coming because they didn't know how to look at what you were doing because what you're doing was not standard in the first place. Anything outside the norm tends to raise regulator concerns, at least until they get familiar with it, they get comfortable with it, they understand what the risks are to consumers, what is a danger, what is not a danger, and then things tend to back off a little. And frankly, we saw a similar effect with even the rise of the robo-advisor 6 or 7 years ago, where there was a whole bunch of regulatory focus on them and to begin with, as regulators tried to figure out, is this a new thing? Is this a different thing? Do we need to regulate it differently? Can we just kind of apply the same regulations, but in the robo context, as they were sorting through? And so I think we are in that sorting process and phase right now, frankly, with regulators, where here's this completely new thing. And what I think we're seeing from regulators so far is a bunch of, whoa, what the heck's going on here? Like, you're not literally doing anything illegal or wrong. Like, we don't need to come in and shut you down, but we're concerned. We're concerned about what's going on. We're trying to figure out what the issues and risks are. And that, to me, is the stage that we're in, with the caveat that because of what XY Planning Network does in particular, we champion these fee-for-service models that are not necessarily assets under management based. It naturally means virtually all of our advisors end up being state registered, because we literally would never get close to that $100 million limit to trigger SEC regulation. And so rather than just having a model that shows up that federal regulators have to deal with, hey, here's a new thing, figure out what you're going to do with it, which is what the SEC and FINRA did with robo-advisors, we've shown up with this new model that doesn't trigger SEC regulation, it triggers state regulation. And so we don't have one regulator that's reacting. We have 50 state regulators that are reacting. And when you put a new thing in front of 50 different regulators, your odds aren't good. You're going to get one opinion that's consistent across all 50. You get a bunch of different ones. And that's very much what we're seeing in practice now, which is some regulators have looked at this and said, yep, looks fine. Others have looked at it and said, well, I've thought of a way that this could be bad for consumers. I want to dig deeper on this. And then a different regulator says, no, I want to dig deeper on this. And we're just seeing a lot of different states respond in different ways, all trying to fulfill their mission of, we just have consumers, and particularly with a new thing, we want to make sure consumers are protected and the industry doesn't move so fast that people get harmed before we figure out how to properly regulate it. And so we're in that back and forth phase of, we're driving some, what I think ultimately is very positive innovation, and regulators are trying to react and make sure that consumers are still protected as this thing shows up.
Yeah, Scott, what are you seeing from your perspective? Is that anything to add to that?
Right, absolutely. So at the core, and we talk about this a lot, our webinars and things that we discuss here with the network, at the core is the failure of regulators to, or the inability of regulators to be able to rely on traditional audit practices, right? So going back to what Michael was saying, regulators are comfortable, I believe, with the way that they have traditionally executed their regulatory exams. They don't want to reinvent the wheel. And so when you remove their ability to do a basic AUM calculation, okay, where they can drill down to the nearest penny in terms of the fee that was charged, when you remove that, now you are introducing an entirely new set of criteria upon which they are going to evaluate the services. And so I think that what Michael's saying is exactly right. We're introducing something new. And at the core of why this is creating an issue is the inability of regulators to rely on traditional audit procedures. And so we're starting to get some pushback there. The other piece of the puzzle that goes along with that, okay, is the failure of the regulator to be able to view financial planning services as a separate and distinct service. And so where we're running into issues in many cases is where the regulator wants to be able to evaluate whether or not the fee is reasonable. Okay, and there's this concept in compliance, reasonableness of fees. And you'll see that at both the SEC and the state level. And so traditionally, an AUM calculation has been used to determine whether or not a fee is reasonable. You remove that AUM calculation and then you introduce a new service. Okay, now the regulator is charged to evaluate that service independent of the AUM calculation. Okay, and so again, it's regulators are not able to rely on their traditional audit practices, and they are not getting it in terms of viewing financial planning as a separate and distinct service.
So you're talking about a couple of issues here. So one is reasonableness of fees. A second one that we've heard is around unethical business practices, and tied in with that, but maybe a third is just what's the service being delivered. So let's just start at the top, and then we'll go through this list. So one is reasonableness of fees. So Scott, you mentioned they want to be able to go back to this AUM calculation. Most states do have a 2% of asset under management line, that any fees over 2% AUM for investment management is too high. That would constitute an unreasonable fee. It needs to be under 2%. So historically, when you do financial planning for free as part of an investment-based relationship, if you had 100,000 AUM, then as long as you were paying less than 2,000, it's fine. If you have $1 million, you're paying less than 200,000, it's fine. The challenge that we're starting to run into is, again, this reasonableness of fees is that they're saying, hey, you charge $200 a month for financial planning, which is fine as long as your client has a bunch of money. But if they only have $10,000 in AUM, a $200 a month or $2,400 a year fee is 24% of AUM, which is significantly higher than 2%. And some of the frustration has been, we view it as planning as one service, investment management as another, but some regulators, not all, and I should go ahead and caveat this, everything that we talk about is an individual regulator thing. And so some state regulators have different concerns throughout this. So not all regulators believe all things that we're going to talk about here. But is there reasonableness of fees that in the end, you can't charge 24% AUM? And we're sitting here saying like, no, we don't. We're charging $200 a month for financial planning, and we charge less than 2% for AUM. So what are the concerns that you're hearing from regulators regarding that? And what is sort of your answer to them whenever they're lumping together financial planning and basing it on an asset-based fee?
Right, exactly. So that really does get to the core of what we are trying to accomplish in terms of our communications with regulators. Regulators want to see consistency. Okay. And what we are finding is that by introducing this model with various options for how clients can pay for financial planning services, regulators are not getting consistency because all advisors are not providing consistency, right? So when you look at financial planning as a field, right, you're going to have various topics that will be covered. And with each of those topics comes a certain level of complexity. Okay, so one financial planning engagement that only addresses college loan debt, right, presumably would be less expensive than another financial planning engagement where we're doing small business planning and perhaps we've got some pension and profit sharing plans of employees that we're dealing with and maybe even some equity compensation issues, right? So those are two completely different services, but they are all being lumped in from the regulatory perspective under quote unquote financial planning. And so the question for the regulator or from their perspective becomes, okay, with these two completely different services, how do we gauge how much more based on complexity factors an advisor should be charging for more complex financial plans? And so there's no mathematical equation that's just going to be a plug and chug like the AUM model. Okay, they're not able to really put anything together from a quantitative perspective that allows them to determine whether or not the fee is reasonable. And so I think that's the biggest obstacle that they're facing.
So, Michael, if you were talking to a regulator, and again, I've had these conversations, and they're very frustrating because I feel like we're talking in two different languages. When someone says like, but the planning fee is more than 2% of AUM, and I have struggled to really communicate my thoughts on this. So, how would you communicate to a regulator? These are distinctly different services, and the fees really, the reasonableness of fees shouldn't be assessed against each other.
Well, so it's a tough comparison, and so the interesting effect that's cropped up that we're seeing is as regulators try to figure out how to tie fees back, particularly planning fees, the direction that they've gone is say, well, let's look at the time. Right. Ultimately, all services are kind of a delivery of time. So we're gonna try to figure out how much time it takes you to do this stuff, or frankly, we're gonna ask you like how much time will it take you to do this stuff. And if we can't calculate the fee as a percentage of assets, because the client doesn't have assets, you're mostly doing planning stuff. The regulators are trying to bring it back and then say, okay, well, what's your total fee and how many hours are you going to spend? And let's do the math that way, and we'll figure out what your implied hourly fee is. And so we have had some success in talking to regulators, say, look, you can't measure this solely as a percentage of assets. I mean, heck, in the logical extreme, if I take someone who desperately needs my financial advice, makes $500,000 a year of income and can easily pay it, but they've never saved a dime, that's why they're hiring a financial advisor, because they're making $500,000 a year and blowing through it. Like, my AUM fee is infinity because I'm dividing by zero. Like, it doesn't work to solely divide into AUM. You have to at least come back and look at the hours instead, or some other paradigm than just AUM fee alone for non-AUM services.
So you're sort of jumping to the next conversation, which is what happens when we can get past the AUM based fee. But I mean, any thoughts specifically, the math you just did, that if you have no assets, but you make $500,000 and we're not allowed to charge even $200 a month, $2,400 a year for financial planning. Sometimes we can't get that far. Sometimes like that, there's still but it's more than 2% of AUM. So we have to do the calculation and be sure we never charge more than 2% AUM. And I know it's frustrating, but any thoughts on how our advisors or how we should be communicating to the regulator to help them maybe conceptualize our side of the world, which is that planning and investment management are separate and distinct services?
Yeah, I mean, the driver just comes back to conveying that planning and investment management are completely different services. We actually did a post on the blog a couple of months ago that turned out to be phenomenally popular, kind of talking about this, that, so the industry view, even from our end within the industry, never mind the regulators for a moment, the industry takes a very AUM centric view to everything that we do. Affluent clients have a lot of money and therefore a lot of investment complexity and have more complex portfolios. Young people, like air quotes, young people have less in assets. Therefore, they can simply have simpler portfolios. They really just need to save in the first place and buy an index. And so I'll hear even within the industry, like, well, I don't even know what value would you provide for a young person? Like, literally, what value would you provide? Their investment needs are very simple. Like, get them to save whatever they can, a couple $100 a month, automate the savings into an account, buy some index funds, and put it on autopilot for 10 or 20 years. Like, what the heck do they even need in the first place?
I wish it was so simple. As a millennial, I wish that was my financial planning situation.
And so the first conversation that we'll get into, either with the industry, frankly, or with regulators, say like, look, let's just put the investment portfolio aside for a moment and think about, as you're going through your 20s, 30s, and 40s, like what kinds of life events happen that necessitate financial advice, right? Because it's usually like life events and things that cause money, emotion, or life change tend to create a need for financial advice. And so when we start looking down that pathway, like, you're getting your first job, you're moving out from your parents, you might be going back to school, you're going to get married, you're going to have your first home, you're going to have your first kid, then you're going to have your first divorce, then you're going to have your second marriage, then you're going to have your second kid, then you're going to change careers, then you're going to start a business, then by now your parents are elderly and you need to help out with them, and then your kids are going off to college and you're transitioning empty nest. And like, when you go through it, there's a financial planning thing that has nothing to do with the investment portfolio that crops up often as much as like every year or two in life, pretty much continuously through your 20s, 30s, and 40s. And so just conveying to regulators like that giant list of stuff and all the different planning issues that come with that, never mind annual tax planning, annual employee benefits planning, annual career planning around your salary and what you're earning, and a whole bunch of other routine annual stuff. All of that is a service that has nothing to do with your investment portfolio and might literally take 5x or 10x or 20x the time to do all that stuff rather than just, hey, check the box on a simple asset allocation. And so that to me is the starting point of conveying like there's so much stuff that gets done in financial planning, including for young people, that has a whole lot of complexity. It's just like you can't compare it to their asset base because it's literally not asset centric in the first place. It's really more income centric and cash flow centric. Like what happens with all that stuff is much more a conversation around where are you directing the income that comes into your house, not where are you directing the assets that sit on your balance sheet.
So unfortunately, Michael is speaking to the choir a bit. Most listeners here know all the things we do for financial planning, which is what leads to the frustrating conversation of then why does it matter what the fee ties back to AUM? So Scott, I'm trying to remember all the states or the couple of states that have had an issue with this. Nevada comes to mind that's one. Are there any other states that currently are using this 2% AUM and using the planning fee to evaluate against it?
Yes. So the state of Washington comes to mind as one that has given some pushback in terms of utilizing that specific that specific 2% of AUM metric. I don't think that that's the broad issue. I think that what's actually happening is just that different regulatory offices are finding ways to create, quite honestly, what we feel at this point is an issue that does not exist. We are not finding rampant abuse by financial planners in this piece. But I want to just kind of go back to something that we were talking about a little bit earlier in terms of overcoming some of the objections that we are seeing with the financial planning fees. So basically, one of the things that I think that advisors should do is focus on specific and consistently delivered description of services. So going back to the earlier point where regulators are frustrated with the inability to be able to find consistency, I think a lot of the reason why is because a lot of financial planners don't focus or spend enough time on the description of their services. And I'll tell them, practice describing your services to your clients and practice describing your services to regulators, because the more consistent the details of what's actually being provided, then the more consistency you're going to have when it comes time to start charging the fees and having regulators review those fees. So that's a key point. And then another one is to make sure that everything is documented. So whatever financial planning process is implemented, if it is documented, then that's how you are establishing a hard copy version of the consistency of the services. So in other words, you're handing documentation to a regulator so that they can evaluate, okay, a client with a certain risk profile or a client with certain suitability criteria across the board, all of these clients are being treated, quote unquote, fairly. And I think that that's another key point that we want to focus on to move this along.
Yeah, it's a great point that in the end, we're sort of jumping ahead a little bit, but what can you do as an advisor in order to move the conversation? And I do think that if you have this sort of really broad base, like we do comprehensive financial planning, and that's all you really say, the regulators are going to say, now, wait a minute, like what is comprehensive financial planning? Because you can just say, I do investment management. They get it. They've seen it. They know the 42 steps that you're going to take on a regular basis regarding investment management. You still need to define it. But if you come in sort of broad broad base with your financial planning service, then they are going to dig deeper and they're really going to ask you to justify. Now, some states are going to ask you to justify no matter how detailed you are, but that is something that you can be prepared to be able to clearly articulate what you do and the value of what you provide and why the fee that you're charging is reasonable. Because in the end, the regulator is very concerned about reasonableness of fees in order to protect consumers.
I think there's an important point there, Alan, really fast, that's worth emphasizing as you're talking about this, which is that the regulators at the end of the day just want to make sure you're actually you're going to do something for your fee and that you actually do what you say you were going to do, and that they have a way to figure out that you did what you said you were going to do, and you don't just tell the regulator you did it, but if they ever asked a client, they would find out that you're taking the fees and not doing any work. So it's just those combinations of things of, are you going to offer something that justifies the fee? Can you explain what it is you're going to offer of value? And can you show that you actually did the work? Which is really what all of this comes down to at the end of the day. The only distinction is, as you pointed out, regulators know how to evaluate that in an investment management context. We've got the systems, we got the structure. They know what their audit points are, as Scott had noted earlier. They know what they're looking for when they come in and ask questions. And they just don't know yet in the financial planning realm. And so they're trying to figure it out, and they're trying to figure out how to anchor and evaluate reasonableness and follow through on these items. And some different states are doing it slightly different ways, which is what Scott had noted earlier. But it's not as though, and I think it's important to clarify, it's not as though regulators are coming in and saying advisors aren't allowed to do financial planning and charge for financial planning. We've never had a member who just outright could not get registered as an advisor and charge for their services and run a business. This is not regulators are coming in and shutting people down. It's just that at the end of the day, regulators need to understand that what you're charging is reasonable. You're doing stuff for the charges and that you can show what you're doing. And they're trying to figure out, frankly, the best ways to evaluate that and measure that. And we're getting slightly different interpretations from different regulators about how to do that. So exactly what you do, how you have to frame it, and which boxes you have to check are varying a bit from one state to the next.
I think that's a great segue into the next piece, which is all about the term reasonable. So some states view reasonableness through the lens of an AUM calculation, and more so, they will view it through the lens of basically tying back the service that you provide to the number of hours that you spent providing the service. So the one that listeners may have heard about, if you're in our VIP group, you've heard discussions here, is Washington seems to be at the forefront of really pushing this conversation that they don't really care about the value of the plan that's being delivered. They really only care about the number of hours that were spent providing financial planning. And reasonableness of fees is basically what how much did you charge for the year? What's your hourly rate? How many hours did you work? Do they match up? And if they don't match up, then you got to refund. If they do match up, then you're good. Which also sort of ties back in with, I'll say in general is a challenge, but the second sort of component of that is not wanting to allow advisors to charge for access. Now, again, this is not all states. Washington is sort of the primary one here, but there are a couple other states looking at what Washington's doing and asking themselves, is this direction we want to go? So, Scott, can you talk about the challenges that we've seen in Washington, particularly with tying back to an hourly, and how we've overcome that for the advisors that are in Washington?
Sure, absolutely. So going back to, and I hate to go back to the same points, but they are comfortable with the hourly idea because it gives them something they can measure. It gives them a really basic, easy mathematical equation. The hourly rate times the number of hours, that's the fee, right? Audit closed. Keeps their job easy. And so we have gone back and forth with regulators in Washington to try to find some compromise that would not force advisors into an hourly model that I personally do not think is the best model for financial planning. One of the items that we have been able to find some middle ground on is using the invoice to detail the items that were completed from a financial planning perspective throughout the month. So in other words, every month, if in fact the advisor is providing financial planning services, then the state of Washington has requested that the advisor send an invoice to the client. And one of the things that they would like to see on that invoice is a description of the services that were offered and executed throughout that month. And so that's their quick and easy way to be able to take a document and say, okay, in the month of August, these are the items that the advisor completed for the client from a financial planning perspective, and that's what justifies the fee. Okay, so that's one piece of the puzzle. Another piece of the puzzle is to switch billing, the timing of the billing from in advance to in arrears. So if in fact an advisor is charging on a monthly basis, the state of Washington right now wants to see that that advisor is charging in arrears or at the end of the month. Why? Because if the client does not feel that they received adequate service from a financial planning perspective during that month, then the state would like the client to have the option not to pay. So the advisor is charging $200 a month. If they charge at the end of the month, then the client can say, you know what, I'm actually not going to pay that $200 because I didn't hear from you this month. Presumably, that's the state of Washington's position on that. And so that's been a pretty good kind of meet in the middle piece. It's nowhere near where we want to be because it's completely inefficient for the advisor. It's kind of like I tell folks sometimes, you have to spend hours tracking hours. And so you actually end up charging the consumer more. But that's kind of where we are right now.
Yeah. And so really what we're saying is, certain states, and again, not all states, I'll keep caveating this, but certain states, Washington being the primary one that we're working with on this, is really tying it back to here's what you said you were going to do. Did you do it? And does it actually equate back to the hourly rate that constitutes a fair and reasonable fee? And one of the challenges that we have had, in Washington and some others, but primarily Washington, is just that they want hours tied to billing period. So if you bill monthly, $200 a month, that just easy math, $200 a month, and you charge $200 an hour, that in January, if you billed them $200, you had to do what you said you were going to do in January. In February, bill them another $200. You had to do something. You had to work for an hour in February. But if you bill quarterly, then you just have to provide 3 hours of services throughout the quarter. You can provide 3 hours in January, nothing in February, nothing in March, but that's fine because you billed quarterly and you did 3 hours of work quarterly, which is what I think is challenging about the monthly fee, is that in the end, we have never advocated for providing a monthly service. We consider it an annual financial planning service that then gets billed monthly or quarterly for the convenience of the client. And that has been a sticking point, is that we think of financial planning in an annual basis. We break out service calendars and all that, but in the end, it's 72 things that we do throughout the year to provide financial planning to our client. And therefore, we charge $2,400 a year or $3,600 a year for that. We just let clients pick how they bill, but the regulators are really forcing us to say, here's exactly what I did for the billing period. Either I did it or I didn't. And if I didn't, I have to refund the client.
And part of the frustration for me around this, and one of the themes that's frankly starting to crop up in these regulatory conversations, including from from an advocacy perspective of what we're starting to push forward from XYPN, is just, certainly I truly, I have sympathy for the regulators. I understand the concern and the consumer protection that they're trying to engage in and what they're trying to do with it. But the fundamental challenge is they're applying standards to financial planning models that they literally don't actually apply to the AUM model in the first place. So I have never talked to a regulator or any firm that was audited by a regulator where the regulator came in and said, you bill your clients on a quarterly basis for your AUM fees. Document the meetings and the rebalancing strategies that you executed in this quarter to justify your quarterly fee. In truth, not all advisors meet with clients quarterly. Some only meet with them once or twice a year. Some don't even see every client every year. We don't typically rebalance quarterly. A lot of firms rebalance annually, or they rebalance with tolerance bands or other threshold rebalancing that becomes uneven. And so it's never been a concern for regulators to say, well, you did a meeting with the client in Q1 and you rebalanced their portfolio in Q2, but you didn't do either of those things in Q3. You need to refund their fee. Even though if I then did the same thing with a financial planning fee, they would say, well, quarter one's fee is justified because you met with them, and quarter fees 2 justifies because you rebalance, and you got to refund the third quarter fee because you didn't do either of those things. I feel like there's this mindset from the regulators that financial advisors doing AUM fees spend the overwhelming majority of their time literally managing their clients' portfolios, sitting in front of a computer, just managing it hands-on all day, every day, when they just don't happen to be out in a client meeting, such that there's, quote, always work happening in the portfolio. And when we actually look, we did a very sizable time study for advisors last year, over 1,000 advisors, how do you spend your time? And what we found was the average advisor spends 5 to 6 hours a week total on investment management tasks, which adds up to only 200 or 300 hours a year. The average financial advisor is in a sizable RIA is doing almost $500,000 of revenue per advisor, which means in essence, like the average advisory firm, if you just drill it down to the investment tasks, is generating about $2,000 for their investment tasks. And of course, it's not to throw advisors under the bus. We're also meeting with clients. Firms do a lot of financial planning. There's other things that go on in that process, and that's part of how firms justify their fees. But regulators are looking at these time-based, services per billing interval application for financial planning, and are very much not doing that in the AUM side. And I think what they would discover is if they did that on the AUM side, they would find out that the way they're measuring financial planning is not actually consistent with how they're already regulating AUM.
And I'd love to piggyback on that real quick, because I spoke with a state regulator in the state of Washington just last week. And she said, and I took a very careful note to make sure that I was prepared to really focus on this. She said, the very fact of how you execute the AUM model dictates the idea that you have to provide services, whereas the ongoing financial planning relationship does not necessitate that you provide services. And so, again, I think that this is just something that was stuck in her mind in terms of how she views financial planning services. I disagree.
Well, because that's how firms did it historically. Like, I charge you a little upfront fee because I was basically giving away the plan because I wanted to get your giant portfolio, which I'm going to manage on an ongoing basis for 1% of AUM. So I was like, yeah, I'll do a bunch of upfront planning stuff. And if I charge a fee, you got to regulate that. And then you're just going to judge me by the AUM stuff. So, like, yeah, we don't have to look at that ongoing financial plan.
Correct. And another piece that she said that I took careful notes on, she said, financial planning is task oriented versus AUM, which is ongoing account management.
As though we're like managing the portfolio all day long, and we don't just have investment tasks in our CRM about how we're handling clients.
And I think this comes back to the fundamental belief that we have around what is financial planning. Is financial planning, even investment management, is financial planning, investment management really managing all the things? I love the Carl Richards sketch that has me and then my advisor in the middle and then stupid. So like my advisor is between me and stupid. Is my advisor is who is there to help me from making a catastrophically terrible mistake, to help me make good decisions, to help me do nothing when nothing is the right answer. And my concern with the direction this is pushing is that it is really driving advisors to do things even if things don't need to be done. So I need to go trade or do research I need to churn the account because I need to show activity. I need to show proof that what I did was valuable. What is the financial planning equivalent of churn? And that's not a good thing, that in the end, we're going to be doing more trying to justify our fee. And I think, so, to your point, Scott, that I think it comes back to just a fundamental disagreement as to what advisors are doing, maybe just a lack of understanding from regulators, the world we've all lived in. We've all worked in firms and know we don't literally touch accounts every day. And that in the end, we're making $2,000 an hour on investment management, and we're trying to justify a $200 an hour financial planning fee. And if you look at the long-term value provided by those two services, the long-term value to a client for that $200 an hour financial planning fee far and away exceeds the value provided on the investment management side.
Which is why even in our analysis, we found that like the average firm spends more on the financial planning work than they do on the investment work. But from the regulatory end right now, as Scott said, we assume the entire AUM fee is justified by the 5 hours a week of investment stuff, and we basically ignore the 6 to 10 hours a week that firms do on planning work until we start segmenting them back out. And now suddenly regulators are struggling to figure out, well, what do they do with essentially planning only firms that do only planning and no AUM, or do mostly planning and limited AUM, in a world where most firms do mostly AUM.
Or include investment management in their retainer fee, right? If heaven forbid you include investment management as part of your retainer fee, because then you have to separate out what portion of the fee is attributable to investment management, what fee is attributable to financial planning.
Or not that you necessarily have to, but some regulators are asking people to allocate those fees as well.
Moving that direction. And I did want to bring out one quick point too, Alan. You said, kind of what's the financial planning equivalent to churning in accounts? In my opinion, that would be a cookie cutter financial planning calendar that basically creates a set of tasks that will be executed regardless of whether or not those tasks are relevant to a client's financial picture. And one of the things that regulators have actually, we've talked about extensively is, okay, if we could hand you a calendar that says month 1, month 2, month 3, these are the activities that occur from a financial planning perspective, would that help you evaluate the services that are being provided? And they've said absolutely. And so I think financial planning calendars are awesome. I think they can be used in a variety of different ways. However, if we ever create a financial planning calendar or an advisor uses a financial planning calendar and they don't tweak it to make sure that it accounts for the life changes of the person that they're working with, then that's where you get to the equivalent of churning from a financial planning perspective. You're doing tasks that aren't relevant just to check it off of a list.
Although I think it's worth emphasizing, like that's the concerning outcome of like what happens when regulators push too hard in the wrong direction. They create unnecessary busy work that clients then get billed for. But the focal point of what we're really hearing from regulators right now would essentially be they're not concerned about churning, they're concerned about reverse churning, which is you charge an ongoing fee and you don't do anything. You're charging fees for no actual service. That's what they're most focused on right now, with the caveat that if they drill down too hard to say, well, you have to always demonstrate a service every month on an ongoing basis because you're billing on a monthly basis, that eventually advisors start doing busy work that's unnecessary. And right, the regulator can now pat their back and say, well, I can see there was a service done every month, but the end result is clients get charged more for work they didn't need because the advisor has to raise their fees for all the busy work, none of which actually created value. We were just trying to check a regulator box. And that to me is just that's the tension between, I fully appreciate a regulator want to make sure advisors aren't ripping clients off by charging them fees and doing nothing. But if you push advisors too hard to just do activity for the sake of doing activity, they'll do it and they'll take the fees. But now clients are getting charged for unnecessary services, which may look good to check a regulatory box, but I would argue isn't actually better than fees for no service, because either way, it's not fees for value, which is what we're trying to get to.
The other thing that we've heard from some regulators, I mentioned this earlier, is around paying for access to the financial planner. And that we've had some regulators push back and say, hey, you can't charge for access because you say my client can reach out to me at any time. That isn't actually worth any portion of your fee. And so, basically that we do have to show activity, not just access to the advisor. And one recently, expressly said they were trying to avoid the gym membership model. Easy to sign up, impossible to cancel. And quite frankly, we've been building features into AdvicePay specifically around this. That was something we heard from the regulators early on. That's why we built the client portal and the ability for clients to cancel their subscription payment without having to go through the advisor, which is far and away much, much easier than trying to cancel an AUM fee. Canceling an asset-based fee. And, usually there's like a 30-day lag in everybody's ADV that, even when you cancel, you're still getting billed for the next 30 days. And then, you have to transition the accounts and all of that. Turning off an AUM fee is extremely difficult. Turning off a financial planning fee if you're using AdvicePay, one click of a button and a confirmation, like it's not hard. But that's another interesting piece of this too, where we recognize much of the value of what we do as advisors is we are there when life happens. We know their situations so that when a death or an inheritance or a baby is born or a job change happens, that we're already ramped up. We already know what's going on and that we're then available to be able to answer those questions. Also goes into having the expertise and going to conferences and going and becoming a better advisor. It's the whole, like, you don't get paid $10,000 to bang a wrench. You get paid $10,000 to know where to bang the wrench or bang the hammer, and just, again, there's this.
If you're banging the wrench, you need to go get a little bit more training.
That's how you fix the TV. And I guess that sort of leads into the next part of this conversation is, what can advisors do? So we're going to talk about our regulatory advocacy efforts here in a second, but what can advisors do when they're running up against these conversations or just in general want to be proactive? Is it, go sit down with a regulator, go sit down in their office and have this conversation? Is it email them every day and pound them over the head with this information? Like what are you finding, Scott, is actually effective for advisors trying to explain this, or at this point, are we just at a loss and the advisors really can't impact the perception the regulators have of financial planning at this point?
No, absolutely. Conducting productive conversations with regulators. Most regulators want to be educated and they want to know what issues are facing the advisors in their jurisdiction. They want to know what regulatory changes they can anticipate, and they're willing to conduct the conversation. Advisors tend to shy away from conversations with regulators. They don't want to set off any red flags or create any regulatory exams where there may not have been interest in doing an examination otherwise. But one of the things that I always focus on is telling advisors, look, have the conversation with them. Let them know about your model, the rationale behind how you decided the way that you're going to operate your firm, and take accurate notes of their concerns. When you can talk to a regulator and then bring up something that they may have said 3 or 4 or 5 months ago, it helps move the conversation forward. I think that that's an important piece. And then also I encourage advisors to approach it from the regulator's perspective. Okay, so regulators are not incentivized to reinvent the wheel. I tell folks all the time, what if someone came to your job and said, hey, I'm going to make your job 3 times harder, but I'm not going to pay you anymore, right? You probably wouldn't be very happy about that. And so just approach it rather than getting frustrated with regulators. I say, listen, put yourself in their shoes. Regulators are people too. They're not being paid extra to create this new set of regulations and audit practices for financial planning services. So be patient. Have the conversation, take notes, and build that relationship. I think that's the most important thing right now.
Yeah, what I would add to this or echo Scott's comment of trying to approach from the regulator's perspective, which I know is painful. Like, I'm trying to run my business here. Like, I'm not trying to make your regulator day better as an advisor, but understand first and foremost, like the regulators are not coming in to shut us down. I feel like that's the perception sometimes, that like it's this very antagonistic, regulators are coming to shut me down and I have to defend myself so that they don't. Look, if you're doing something super duper bad, like they're going to find you or try to shut you down. But the truth is, a minuscule for a number of firms ever get shut down. And most of them that do are for like pretty blatant fraud or like continued sustained poor compliance practices. Most of what's happening with regulators at the end of the day, when they're coming for their examinations, they're coming to talk to you, is they want you to demonstrate that you're doing what you said you were going to do and that clients aren't being harmed. And they want to see that you have a culture of compliance, that you care that what you do is compliant and that you're trying to implement processes and procedures in order to make things compliant and be able to document and show that you did what you said you're going to do. And so when you look at it from that perspective, I mean, the truth is a lot of questions that we see regulators ask is, half of it is like, this is a tough question I'm concerned about. And the other half is, I just want to see if you know the answer. Like, if you can confidently explain what your value and services are for this fee, I feel better as a regulator. If I ask you to justify your fee and you can't even justify it to me, now as a regulator, I'm concerned just because you apparently really don't know what you're doing for your own fees. And that's concerning me as a regulator, because if you can't even explain it to me, you're certainly not going to be documenting it very well. And so when you approach it from the regulator's perspective, to understand that at the end of the day, most of what they're trying to drill down to is what you're charging reasonable for the services you're providing? And are you actually providing the services? That's what they're trying to get to at the end of the day. Have that in your mind as you're going through the discussions. And what that often takes you to in practice is just, look, you got to know your business. You should know it regardless, but like, you got to know your business, what you do and how you're managing it and how you're tracking it. Like, that's what comes with being a business owner. And sometimes that's just a regulator holding you accountable to do the things that you need to do as a business owner. And the second point that goes with it is, look, if you're going to operate in a newer space, which is just the reality of fee-for-service financial planning businesses, if you're going to operate in a little bit of a new space, you have to take the approach that you're educating the regulator. So educate nicely, speak nicely, speak politely. Like, this isn't meant to be an antagonistic situation, but you're doing something that this regulator may literally not have seen before or not have seen often. And because we're still in that murky middle phase, hey, here's a new thing we got to, but we haven't fully fleshed out our audit and oversight procedures as regulators. Understand there's a two-way educational dialogue going on here. And notwithstanding the fact that we've highlighted a few states that have been challenges, we've also had a lot of states that gave a lot of pushback to financial planning fee-for-service models 2 years ago and aren't anymore. Because we had those discussions. We had them from XYPN's end. Alan and I have flown out to a few state regulators to see them to have this conversation. Scott and his team have talked directly with regulators on a regular basis because just we're registering firms. So our compliance team is deep in with the regulators quite a bit. And we have members that communicate this back to regulators and say, look, just here's what I'm doing. Here's what's going on. Here's how the client is actually being served well. Here are the good things that I'm doing that validate my fees. And as regulators get more familiar with the model and essentially get new ways to think about it, like comparing to assets is not a good model when you're working with people who don't have assets but need financial advice. You might want to look at the time, but you should look at the time in the aggregate and not the time per month. As they get educated on these things, we are finding that most state regulators, frankly, are relaxing a little around this. Not completely. It's their job to never relax completely. But most state regulators we find are starting to relax around this. It's actually why there's more discussion about a few state regulators that have been high profile, but most actually are not this way in the first place. And that's part of what's driving us from the XYPN end to also say, what else can we do as an organization and advocacy into these states, into a handful of the holdouts, to try to just help push forward that education process of here's what we're doing, here's why the consumer is actually well served, and even helping them spot like, here's where the real danger is. Like, it's not charging clients ongoing fees and doing no work, because the truth is if you charge fees and do no work, like people just cut that thing off. Maybe we don't cut off our gym membership because it's cheap, but like a couple $100 a month of financial planning fees, people cut that off pretty quickly if they're not feeling like they're getting value. The real issue is, did the advisor sign someone up for a fee and then make it impossible to cut off in the first place? And as we view it, like, demonstrate your work every month is not a problem. The client's ability to stop the monthly fee is actually the biggest risk area. And we call that the fee severability issue, which we're now trying to push to regulators. Say, look, here's how super simple and easy it is for clients to cut off their fees. We actually built that into advice pay. So clients are protected because they can just cut it off anytime without calling the advisor. And now, like, you don't have to push the advisor as much because clients have an easy way to control it themselves.
So let's sort of, as we're going to be coming to a close, we could talk about sort of what we are doing from an XYPN advocacy end. And I think it's fair to start by saying we are not pushing the states or NASA, who, Michael, you can introduce NASA. Probably most people have never heard of NASA and think I'm talking about space stations. But we are not pushing the regulators or NASA to stop regulating financial planning monthly fees and just let them go. In the end, we have long known that eventually someone would use our planning model for bad. Some could argue the new Schwab $30 a month is starting to head that direction, because now we're starting to move into gym membership model pricing where it's 10 to 20, $30 a month and you don't actually do anything. It's purely for access. And why is that fair, but our fees are not? It's a whole other conversation, but I don't actually think Schwab's doing anything bad. But I think that it's putting us on this march to that people are taking the model that we've really popularized, and now they're starting to do different things with it. And eventually someone's going to do something bad. So how do we create reasonable rules and regulations that allow advisors to operate in an ethical, very transparent way, which we believe our model is the most ethical and most transparent way of doing financial planning and billing for financial planning, while also protecting consumers from bad actors, while also not, leveling such a massive compliance burden on on retainer-based or subscription-based financial planners that, solo advisors can't stay in business. So, Michael, can you just introduce, first off, who is NASA and why are we talking to them instead of 50 individual state regulators on a more proactive basis?
So NASA, as you said, not NASA, the space folks, NASA. This is NASA, the State Securities Administrators. So NASAA, literally the North American Securities Administrators Association. So, in our planning world, we've got our financial planning association groups like NAPFA. State securities regulators have their own membership association, right? You can have a membership association for anything out there. So we've got one, or actually a few, as financial planners. The state regulators have their own, and it's called NASA. And the primary thing that NASA tries to accomplish is help all of these state regulators have a place to find common ground for themselves. learn best practices from each other. Hey, here's the crappy stuff that's happening in our state. Y'all should know about this. Here's an examination or audit process we found that works really well. Let's do this in other states. And also just literally trying to make states more uniform, right? Because the fundamental challenge with pretty much anything in the domain of state regulation and the whole debate around state regulation versus federal regulation of pretty much anything is when you regulate at the states, different states take different interpretations, and you end out with a patchwork of states that do different regulations. And if it gets bad enough, sometimes eventually a federal regulator comes in and says, y'all are too messed up across the states. We're taking all this away from you. And we're going to do it at the federal level. And so a big part of NASA's focus is let's try to make sure that as best we can, state regulation is fairly consistent. It will never be perfect because different state regulators and different state legislatures will have their own views, but can we try to make state regulation more consistent as well? And so NASA will even do things like put forth model rules. Hey, you're not sure what a consistent way is to regulate this thing in your state? Here's a model rule. Just take it to your legislature, pass it in your legislature, implement it with your securities regulators. And if we all pass this model rule, then we'll all be doing this thing in the same way. And so ultimately, the role of NASA is kind of coordinate best practices with state regulators, try to help support consistency of laws across all the different states so that we get a little bit less of the patchwork effect and a little bit more of a consistent look. Wherever you're doing business, the rules are kind of similar across the board.
So can you talk about a little bit just about what model rule we're pushing? Obviously, we have not written one. We are working with folks that are in charge of this, but just what are we doing in order to help NASA get this model rule built and published so that the states can adopt it?
So we've gone a couple of directions so far. We've put forth the idea to NASA, hey, if we want to figure out the best way to regulate these fee-for-service models, not even just monthly subscription, but retainer fees and setting fee reasonableness for anything in financial planning, we'd be really interested in supporting on a model rule. Like we can bring the industry perspective, obviously you guys bring the regulator perspective, and just beginning to open that dialogue. We've actually had a couple of in-person sit-down multi-hour meetings with NASA, with their executive director, as well as with some of the leadership in the committees that actually run the investment advisor oversight area and that produce model rules in that area to begin building relationships, to begin educating them from the top. We're educating from the bottom up, which is Scott and Travis and his team just going out to every single state regulator that they talk to, and Alan and I going in to talk to states that push back a little bit more. But we're also trying to educate from the top down to say, look, we see issues of regulatory inconsistency that your organization is built to resolve. We'd love to work with you on a model rule around this. We'd love to educate your regulators about not just where the problems aren't, but also where the problems will be in the future so that you guys are looking for the right things when the bad folks do show up. And so, as you said, Alan, like we're not at model rule stage, like let's write the rule and put it out there yet, but we're having active meetings with NASA regulators all the way at the top of the organization. They're hearing this and taking it seriously, in part because XYPN alone now is almost 5% of all RIAs at the state level doing financial planning. Like we're a very material chunk in less than 5 years, and the majority of all of the growth of state RIAs at this point. That's part of why it's become something that regulators have noticed over the past few years, because groups like ACP, Alliance of Comprehensive Planners, originally Alliance of Cambridge Advisors, have been doing these kinds of retainer models for literally 20 years. But they might have only registered a half a dozen members a year across all 50 states. Well, there are a lot of states where we register a half a dozen or a dozen members in a year. Like they see new one from us every month or more frequently. And so it's pushed it more to the forefront now, where NASA is expressing some interest in figuring out what they should do about this. And we're expressing interest that we'd love to be at the table to be part of that, educate them about what can be done right and educate them about where the real risks are. So consumers do get protected when a bad actor comes along.
Right. And when we got the opportunity to meet with NASA most recently, we did get widespread recognition that training should be used as a tool to address the lack of uniformity.
Meaning training of NASA to their own regulators.
Right, exactly. Meaning NASA understands that there is going to have to be a training component in order to gain some type of consistency across regulatory jurisdictions. With every state being a sovereign entity, that's challenging, but at least they do understand that is the direction in which we need to go. And we also got the opportunity to discuss at a high level state and federal conformity. Right. And I think that we were able to get consensus that it is important that whatever the states are doing, that it in some way be in line with SEC registered firms in their regulatory jurisdiction as well.
Yeah, ironically, Schwab's decision to go into the monthly subscription model as well has maybe advanced this conversation a little bit more even at the state level, because now you have a large mega national firm like Schwab who has implicitly gotten the SEC's blessing to do this. And the SEC isn't all up in their hair to say, demonstrate what financial planning services you're providing on every single month, documented to every single client in order to charge this ongoing fee. And so I think that's helped emphasize to NASA as well that just maybe we need to take a little bit more of a moderate view around this in figuring out what really is protecting consumers and what just sort of risk creating unnecessary busy work or just isn't even how consumers are looking at the issue in the first place. The other thing that's worth reflecting on this, just from even what we're trying to do from the advocacy end, is we're not doing this alone as XYPN. In part, that's actually because as much as the regulators have been very constructive in working with us and having conversations, at the end of the day, we are a for-profit business representing a bunch of for-profit businesses. And frankly, business wants to make money and regulators push back is usually opposite ends of the spectrum. They'll only work with us so much because they know, we do have a dog in this hunt at the end of the day. And so we've actually been in the process of building a coalition of other nonprofit organizations that support and advocate for advisors and consumers as well. And so we've been very active with NAPFA directly, and Jeff Brown and the team at NAPFA have been very supportive of this effort. Obviously, they're focused on fee-only advisors, so they would like to see fee-only advisors able to run their businesses and not be regulated to death. We've been working directly with the CFP board. Obviously, the CFP board has its own vested interest in making sure that regulators aren't denying the ability to do financial planning and get paid for it. But CFP board is a nonprofit. They do get viewed a little bit differently from the regulator end. And we've even had some active conversations with the Consumer Federation of America, which is an investor advocacy organization that takes on a wide range of consumer-facing issues around investments. But this is now becoming one of their areas of interest as well. And they're very supportive of this because they understand at the end of the day, financial planning separate from AUM expands financial planning services. It expands the reach of financial planning advice. Although the state regulators haven't picked up on it yet, Consumer Federation has that. This is actually one of the most protected consumer models out there by its very nature, that when you charge an ongoing monthly fee, the moment the client doesn't like the service, you cut that thing off. And it's super easy, right? It's hard even to terminate an AUM fee, because if you're going to terminate the advisor, it's like, well, now where's your money going to go? Are you going to transfer it somewhere? Can the things your advisor bought you even be transferred? And how much of a pain in the butt is it to move all your money around just because you want to fire your advisor? And obviously the commission end gets the most extreme. Hey, I got 7 years worth of fees up front and I may or may not do any work after year one. So when we look at on this spectrum of fee severability, we're finding actually organizations like Consumer Federation are appreciating that this is actually arguably the most consumer protected model that's ever been put forth in financial planning, simply because it's the easiest for a client to shut off and say no the moment they feel like they're not getting value. And that's now part of what we're working with CFA to try to bring back to the regulators to say, look, even the investor advocacy folks recognize this is actually one of the most consumer protected models, not the thing you need to be cracking down the hardest on to say, what are you doing every single month? Not that regulators shouldn't hold advisors accountable, but when it's so easy for people to just stop the fee the moment they're not getting value, you actually don't have to beat the advisor that hard to provide the value. The consumer just literally shuts it off if it's not working and if the fee is easily severable.
So I think just to sort of wrap this up, and again, the purpose of this episode was really just to outline some of the challenges that we're running into, what we're facing, the conversations we're having, maybe give some explanation why it's coming to a head today versus 3 years ago versus in 3 years, which I think we've covered, as well as just what we're doing. And so I would say for listeners who are out there, I think the important takeaways are, don't panic. We're okay. Regulators are not trying to shut down financial planning. They're trying to protect consumers. So don't panic. Educate your regulator. Any opportunity that you get to have that conversation, to tell them how you do business, what you do, why you do it, why you got into this business, and that it really is that you got into the helping profession side of this business. And the more they hear that, which is a very different message than they hear from people 20 years ago who got into the asset management business. All right. So this is just a very different conversation that they're hearing, but the more often they hear it, the better. And take the opportunity to educate when you can. And also let the associations know that you want their involvement in this. So whether that be NAPFA or FPA or CFP board, let them know this is like top of mind issue for you that you want them involved in, because as Michael mentioned, we're going to be heavily involved in this. We're taking the leadership capacity here and trying to push this conversation forward. But the more organizations representing more advisors, the better. That when we approach NASA, it's better than, us having almost 1,000 advisors. It's a lot better if we can say, and we represent 100,000 advisors or 150,000 advisors because of all the different organizations that are here. So, let them know. I think that's why NAPFA got involved, was because they started to recognize that, this is a growing contingent, and really the future of their association are the members that are operating under this fee model. And finally is, say what you're going to do and then do it. And so be really clear anytime you're documenting out what is, from a compliance perspective, but what is your fee, what is your service model? What are you doing for your client? And being very clear about that. How are you charging for it? And then documenting that you did what you said you were going to do. So tell them you're going to do it, and then tell them what you did. It's just like writing an English paper back in grade school, and just being very, very clear with that documentation, which again, the more times regulators come in and they see this model and they see, this is what you said you were going to do, and then you did it, and client satisfaction is high, the more they're going to get comfortable with this model. And finally, we'll do our best to keep hiring regulators. So we just hired a regulator. Kingston joined our compliance team. So he was an examiner out of Minnesota to help us navigate some of these conversations, to have that perspective in the room when we're talking about, the regulator should say this or should hear this. And Kingston's like, no, that's not how that works. Super valuable to have him on the team and helping Scott with a lot of these conversations. So Michael, Scott, thank you both for taking time to come on the show today and talk through this with us. Hopefully this is a huge benefit for listeners. So thank you both so much. XYPN Live is a financial planning conference unlike any other in the industry. At XYPN Live, you'll learn real strategies for building your firm, whether you're just getting started or you're a seasoned firm owner. Or maybe you just want to earn some CE credits, connect with other advisors, or be part of the real financial planning movement. XYPN Live offers all of that and so much more. Go to xyplanningnetwork.com/XYPN Live Radio to get your pass today. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitces, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.